equity should enhance your financial plan. It should definitely not be your entire financial plan.
Absolutely.
Who the f am I to tell you what to do with your money?
My name is Priya, currently managing millions of hardworking dollars. Enough foreplay. Let's talk money. Welcome to the F word. Smart money.
No bull.
Hey guys, welcome back to the F word, where I help ambitious 30-somethings get their financial shit together so they can live well now and build wealth for later. Today, we're tackling one of the most confusing and potentially lucrative topics out there, startup equity. Whether you've been offered options, RSUs, or just a whole lot of promises, today we're going to help you get clear and make sense of what you're being offered. Joining me is my very good and insanely credentialed friend, Liran Amrany. Liran has a master's in financial engineering from Berkeley. He then spent 9 years on Wall Street for JP Morgan. For the last 11 years, he's been heavily involved in the fintech community, founding and incubating companies, advising companies, investing in companies. Most recently, he was a partner at Team 8, $1 billion venture capital fund based out of Israel. He works with a lot of early stage founders, and in full disclosure, he's on the Stash Wealth Advisory Board. Thank you so much for joining me, Liran.
Thanks for having me, Priya.
All right, let's get into it. So I want to demystify the concept of startup equity so that people can really understand the value in terms of their portfolio and also the compensation that they're being offered directly for taking on these types of risks. So obviously, a lot of our clients get offers with a lot of confusing acronyms, which I really want to demystify with you today. So let's start with what is equity compensation? And maybe then we could touch a little bit on the most common types being offered to professionals in their 30s these days. So can you take us through it? Just start with what is equity compensation?
So at a high level, equity is how companies, not just startups, will incentivize their employees, one, to prioritize the well-benefit of the company, and two, to stay. So typically, there will be a vesting period of, with startups up to 4 years, so that encourage you to stay for the full length, especially if the startup is doing well and you want that equity is more valuable. You want to stay for the full vesting period. But more than that, they want everybody focusing on company value creation. And the best way to do that is by making part of your bonus, your salary, your income based on the value of the company itself.
Got it. Okay. So like aligning incentives between the employee and the company's goals so that everyone's pushing harder to help the company become more valuable.
Exactly. And with startups, that's typically more possible. Like in a smaller company, you can have more of an impact on how well the company does. When I worked at JP Morgan and got paid in equity, I wasn't directly influencing the value of JP Morgan equity, but it was still, a way for them to have us sort of aligned with shareholders and sticking around for long enough for it to vest.
Basically, it was peanuts is what you're telling me. Okay, cool. That's helpful. So typically, equity compensation is more of a consideration and becomes a larger decision when the company is in its earliest stages. Can you talk me through some of those stages and what are some of the common types of equity compensation, starting with like seed?
Yeah, so the upside downside is much higher the earlier the stage of the company. So, when I was at JP Morgan and got paid equity, certainly the stock fluctuated a lot during the financial crisis, but like JP Morgan so they weren't going bankrupt. Some other banks did go bankrupt, unfortunately. But with a startup, your equity can go up 100-fold, it can go down to zero, and both of those are, not that crazy. That doesn't take a once in a lifetime financial crisis for that to happen. So most startups will issue what's called the ISOs, incentive stock options. And what that does is it allows employees the ability to purchase stock at a predetermined strike price. The strike price is usually determined at the time of issuance, and you don't have to exercise it until either the company has a liquidation event, so it goes public, it sells, and you want to sell the stock, or if you leave the company, typically they'll give you 90 days to exercise. And that's where some of the complications get into as well, that I'm sure we'll talk about a little bit.
Taxes, things like that.
Yeah, taxes. Yeah, it costs money to exercise the options, and like some people don't have that money.
Right. That's a really, let's go there. Okay. So you talked about ISOs. So let's just break down. Those are very common. We see them a lot. Let's talk about what an option is. What is it really? Explain what an option is.
An option is a contract that lets you buy stock at a predetermined price. Now, typically the way it works with startups is you have the valuation that is publicly disseminated in press releases around funding deals and things like that. And then you have the A valuation, which is the valuation assigned to the common stock. And so investors, when they invest, are getting preferred stock. There's usually a higher value there. As a startup employee, you're getting an option to buy common stock. Usually there's not much of a difference. The difference happens when there's like maybe a liquidation event that's not great and the preferred investors have the ability to recoup their money first. But in the outcomes that you're hoping for as a startup employee, the company goes public, everything gets converted to common and your equity will be worth the same. So it's actually a good thing from that perspective that the common equity is worth less when you're getting the option, because that means your strike price is lower. So the price that you have to pay to exercise to buy that stock when you decide to do it will be lower. It's usually tied to that 409 valuation. And that's typically just, it's like a regulatory type of procedure that companies will do where they get a third party to value the company. And that way they're not, they're not issuing equity at prices that are too low or too high. And they have basically a third party they can point to and say, this is how much they said the company was worth.
The fair value of the company at that point in time.
Fair value of the common equity at that point in time. Yeah.
Okay. So what about in terms of how many options? I think that's a confusion that a lot of people have is they're given their options in terms of like 1,000 options or 10,000 options. And that just seems so confusing as to how you tie that number to the valuation. Can you maybe talk a little bit about that?
Yeah, there's a few moving parts that could get a little bit complicated. The number of options, it can be misleading because at the end of the day, you don't know how many outstanding shares the company has. And so, 10,000 shares on a company that has 1 million shares or 10,000 options on a company that has 1 million shares outstanding can be more than 50,000 options on a company that has 1 billion shares outstanding. And the number of shares outstanding can vary widely, and it is typically very, very large. So one of the things you should ask when you're being offered equity or offered options is what is the current number of fully diluted shares outstanding for the company? So that you can understand what percentage of ownership does this mean if you exercise. And so that's one important thing because you want to know, okay, if the company goes from, maybe today it's valued at $25, $30 million and you think there's tons of potential, or you just want to map out, okay, what happens if it goes down to zero? What happens if it exits for 50? What happens if it exits for 1 billion? What's important from your perspective is what portion of the company you can own. And then the other thing is like, okay, how much money is it going to cost you to exercise the option? And that's where the strike price and the number of options do come into play. So you might say, okay, I have 10,000 options. There are 1 million shares outstanding. So if I exercise, I would own about 1% of the company. Again, there could be more dilution in the future. That number is not set in stone, but just ballpark if you're trying to sort of do the math. If the company is worth $1 billion, that is $10 million of potential equity that I own, but I have to know what that strike price is. So if the strike price is $100, I have to pay $100 times 10,000 stocks just to get those shares in my name. And so you're talking about going from, that's $1 million right there. So I have to pay $1 million to get those shares, and then it's worth $10 million, which is still a great outcome. But it's important to understand, obviously, the dynamic between the number of shares, the strike price, and the percentage ownership that you would have in the company.
You're one of those rare people who can just do math in your head, aren't you?
I try to use easy numbers.
That was helpful. We just covered a lot of ground there. So I want to back up and talk about what you can and cannot ask. So just hitting on a couple ideas, the 409A, fully diluted share count. Let's just start with those. Can you ask about the evaluation? And how do you make sure they're not telling you something that is out of date or looks better than it actually is from the valuation perspective?
I mean, that part's tricky. You simply have to trust the company. You're building a trusting relationship there, right? Like when you're joining, especially an early stage startup, even a growth stage startup, like you're putting your faith that like these people know what they're doing and they're going to do the right things by the shareholders. I think you want to believe in the founders in more ways than one. I think that's very important for any job that you're taking. Believe in the people that you're working with and working for. But in terms of like what you can ask, you should feel free to ask everything. And most of the stuff they should be able to tell you. And it might be in different terms. Like maybe it's, what is the current valuation? What percentage of ownership would this represent if I exercise all the options?
So what is the valuation? You can just straight come out and ask them.
Like you can back, all these numbers tie in together as well. So like from some, you can back into others. If you ask, what is the strike price on these options? What is the number of options? And what is the current, public valuation of the company? Public meaning like, at the last capital raise, you can figure out the rest. Like you can figure out the percent ownership. Well, you need the 409.
You need the 409A.
There's the 409A valuation, which is like the common equity, and then there's the preferred equity valuation, which is what you read when you hear that, like, hey, this company OpenAI just raised at a $10 billion valuation. Like that is what the investors are getting when they're buying preferred equity. The 409A valuation for the common equity that employees are getting is going to be a little bit lower.
Yeah, you're right. That is a good distinction. Anyway,
OpenAI might be public because they announced it, but it's not, the equity is not public. It's still private equity. It's not traded publicly. The valuation itself is public, but in many cases it's not. In many cases, companies will raise a lot of money and just not issue press releases. So that's the number that matters, is the valuation at the most recent capital raise, where the valuation when they sold equity most recently. So like all the numbers tie in together. And so you can back into some of the numbers from others. If you know the percentage of the company that you have, then you'll know how many fully diluted shares is outstanding.
Okay, because you'll know the percentage you have and the count that you have, and that'll allow you to figure out how many is total outstanding. Okay, that brings me to the next thing of fully diluted. Can you talk a little bit more about this concept?
So when a company is formed, they set aside a bunch of shares. And this is just like a technical legal kind of framework. And then they start issuing shares. And so they'll issue shares typically every time there's a funding round. Well, they'll issue initially to the founders. So the founders get founder equity. And then they'll issue shares every time there's a priced equity round when investors are buying into the equity. And then as part of those funding rounds, there's usually an option pool. And out of that option pool, they will issue options to employees. Typically, once you start maxing out these numbers, then you have to sort of like do another, not necessarily have to do another funding round, but you have to do a whole another like legal kind of round of issuing more shares. And so the fully diluted shares outstanding is just the total number of shares that have been issued to founders, investors, and that would be exercised if all the employee stock options were exercised.
Can you put that into like an example for us?
So,
Like
typical
with numbers,
example,
easy numbers.
easy numbers. So we'll use the 10 million shares outstanding. So typically, the founders after one round maybe have 70 or 7 million of those shares. The seed investors that came in maybe own 2 million of those shares. And then 1 million shares have been set aside for stock options. Maybe so far they've only issued, 500,000 of those.
Okay.
From a plain English perspective, it is how many shares would there be if everybody exercised their options. So it helps you determine what percentage of the company you would own. And that's why I said they all sort of tie into each other.
Okay. So fully diluted means the number of shares that would be outstanding if everyone exercised their options.
If everyone exercised their options, if there's other warrants outstanding, but basically, it's not counting shares that haven't been issued yet. It's not counting.
Right. So one option to one share. Is that how that works?
Yes. In this framework, yes. If you're trading options and you're like Interactive Brokers or Fidelity account, it's a little different.
Yeah. Okay. So in the startup context of what you're typically being offered, one option translates, if you exercise that one option, you end up with one share in the company.
Exactly. And the idea behind the fully, like understanding your fully diluted or your proportion of the fully diluted shares is what happens if there was an exit tomorrow. Because presumably, if there was a good exit tomorrow, everybody would exercise their options. And I would tell you how much you own, but like you don't know what's going to happen in a year or 2 years. So there's no way to say like what portion of the company am I going to own when we exit in 5 years? Because you may do 3 more like rounds of fundraising, you may do none, but there's a whole bunch of different factors that go in there.
And more shares could be created.
more shares could be created as well. And all that will dilute you over time. So you should expect to be diluted over time, but that's not a bad thing because it means the company's growing and raising more money. So your portion of the company, your portion of the pie may be getting a little bit smaller, but the pie is getting a lot bigger.
More valuable.
Yeah.
Beautiful.
I should say your percentage of the pie is getting a little bit smaller, but your portion is still getting bigger. As a portion, your slice is growing in size.
Are we talking about pizza? I've totally lost track.
Are you hungry?
I am always hungry for pizza. Okay. We've talked a lot about like seed and early stage. If your company's a little bigger, like let's say series A, B, C, what are some of the common equity compensation types that might be offered at those levels? Maybe still options, but what else gets introduced, or how should we think about what we're being offered?
So ISOs are still the most common for later stage companies, and this is really much more common in public companies than in private companies. They'll just issue restricted stock units. So this is, for example, what I got when I was at JP Morgan. And in this case, you're getting actual stocks. So there's no option. You don't have to buy or sell. You just have to wait until it vests. And then you own some shares of the company. There can be other things like NSOs and phantom shares. NSOs used to be a lot more common. And there's basically just a small tax difference between the two, but it's a small tax difference that can end up being very big in certain bad situations. And it really impacted a lot of people during the dot-com crisis in like the early 2000s. And so maybe I'll explain a little bit on the tax difference.
Sure, please.
So with an incentive stock option, when you exercise, you don't pay any taxes. When you sell the stock, because exercising means you're buying the stock, and then you might hold on to it for a day and then sell. You might hold on to it for a year and then sell. When you sell the stock, assuming that you have held on to it for at least a year and that it's at least 2 years since the original grant of the stock, then you pay taxes on the gain from the strike price from where you paid until the price that you sold. And that's all long-term capital gains.
Which is a lower, more preferential tax rate.
Right. With NSOs, what happens is when you execute the option, you pay ordinary income on the difference between the strike price and the fair market value at that point in time. And then when you sell the stock, then you pay capital gains, long-term or short-term, between the fair market value and the fair market value at the time of exercise and the sale price.
So ISOs sort of have a more delayed tax consequence or
Exactly.
tax impact.
And the issue that happened in the 2000s is that people executed their NSOs. As I mentioned earlier, if you leave a company, oftentimes you have 90 days to decide whether you want to execute it. So like if the company's doing really well, you definitely want to do that. And then that then generated a tax liability because the fair market value at the time of the exercise, might have been, $1,000 per share, and their strike price was $100 per share. So the value of the company went up 10x since they joined the company. And so now all of a sudden they have millions of dollars in taxable income, but then the market just completely crashed. And it was either while the company was still private or even after it went public, but before they had a chance to sell. And so all of a sudden you had a lot of employees of tech companies who had, $1 million in tax liability, but they didn't have $1 million worth of shares to even liquidate and pay. And so, it's a big deal because you can't write off tax liability. It's something that will chase you for years. So the incentive stock option is meant to alleviate that issue so that you don't pay taxes until you sell, and only if there's a profit from the fair market value when you were issued the shares, as opposed to when you executed the options until when you sell the share. So the one difference with ISOs where you don't have to pay taxes until you sell, there is one loophole there, which is if you're subject to AMT. So when you exercise the options, you're not paying capital gains or ordinary income, but it could trigger some additional tax within the AMT framework, which is way too complicated for us to get into. And
I was going to say,
equity.
The takeaway here feels like bring in a tax expert if you're in that situation where you're trying to figure out how to decide. It's not so much about deciding how much it's worth to you. It sounds like it's more of a a planning decision, a long-term decision
Should you
around.
exercise or not? It usually won't come up until you're ready to exercise. I think most situations you're going to prefer ISOs to NSOs.
Mhm.
And I think most companies offer ISOs. I don't know too many that do NSOs these days.
Okay, that's helpful. So actually, let's talk a little bit about planning. So when you're getting equity compensation, you consider it as part of your total compensation. Part is in cash, part is in, let's call it deferred, which is this leveraged aspect, right? You're getting equity that can be worth more in the future than it is today. So deciding how much of your total the equity portion should be, or how should someone think through how much equity they take relative to cash?
Yeah, there's no, there's no hard and fast rule. I mean, the easiest way to look at it, but I'll explain why this isn't necessarily the right way to look at it, is to look at the current valuation of the company. And if the current valuation of the company is $10 million, the strike price, because of the 4.9A valuation that you're getting on a company-wide level, is maybe $3 million, and you're getting, 1% of the company, you're getting, so 1% of $10 million, like 100K, but you have to pay 30K to exercise that. So you're getting 70K worth of value in these options at today's valuation. And so you can spread that out over 4 years and say, okay, that's equivalent to about, $18,000 a year for the next 4 years. But the thing that's important to know is that nobody's taking startup equity because they think it's gonna remain static over the next 4 years. So it's either gonna go up or it's gonna go down. And you have an option as an employee to stay at a company or to leave. And so you sort of have to map out the different scenarios. And if the company ends up, not lasting and going out of business in a year, fine, you spent a year and you didn't get any equity at all. If you're there for 4 years, it's probably because the company is doing well. If the company's not growing that much, then you have the option to leave it. And so as an employee, you could say it's worth $18,000 a year, but there's a scenario where in 4 years, it's now worth, instead of 70,000 total, it's worth 700,000 total. And I, as a person who has equity vesting on typically a monthly basis starting after year one, I can stay for that first year, get that first, 25% of the equity, and then decide if I want to stay or if I want to go. Not that I'm suggesting that people go work for a year at a company and then move around. At some point, I think you're going to get a lot of questions in your next interview. But I think just in terms of thinking about how to value it, you don't know what the startup is going to be worth in a few years. You want to join a company that you really believe in and that you think is going to do well. It's almost impossible to put a number on it, but you should know that you're not making a decision today based on where the valuation is going to be in 4 years. You have decision points at all through the next 4 years where you can decide, do I stay? Do I go? Do I ask for more equity? And hopefully, that company does well and it's not an issue.
Yeah. And so the trade-off there is, what is the cash today? Can you live on it? And the more you believe in the company, the more you want to trade cash for equity.
I think so. It very much depends, to your point, on what financial situation are you in? Are you in a family? Do you have, do you just have a couple kids? Maybe you don't have as much flexibility. Are you single? You have a lot of money saved up. Maybe you can afford to live on a little bit lower salary and roll the dice a little bit more with equity. You should know that you are taking a risk. And this is it's like angel investing, but with your time. Anytime you write an angel check into a startup, you should know that there's a good chance that it's going to be worth zero. But if
worth zero, yeah.
You're really good at picking and choosing, and you really believe it in a company, and as an employee, you have some agency to actually help the direction and the success rate there. Then certainly there's the possibility, which I think is what excites a lot of startup employees, that could be worth a lot more in a few years.
Okay, so helpful. One more thing, just before I let you go. You've touched on vesting and talked about the standard vesting. So can you explain vesting? What do you mean when you say standard vesting schedule? And why is vesting a thing?
So that part's the easy part. Vesting is a thing because companies don't want to give you a ton of equity and then have you leave the next day. And so in order to incentivize you to stay for a reasonable amount of time, they will typically make sure that equity vests over a period of, at startups, the standard is 4 years.
4
So-
years with a 1-year cliff. What is 1 year cliff?
So that means you're not getting any equity at all for the first 11 months. If you leave or you're fired in those 11 months, you walk away, you don't have anything. After month 12, you get a quarter of the total equity. And then from then forward, typically every month you're vesting another, 1/48th, because there's 48 months over those 4 years. So it's a quarter every year, but in monthly installments starting after year one.
Gotcha. Thank you. That
And
was
so a
helpful.
lot of people will talk about the cliff, as in like, staying until that first year so they can at least get some of the equity that they've worked for over the course of that year. And a lot of people will stay for 4 years to get, if a company's doing really well, you don't want to leave that equity on the table, but maybe you're just ready for a different challenge or something. And a lot of people will wait for the end of the 4 years because, they got equity when the company was worth 10 million and now it's worth 200 million. At that point, you can put a value on how much that equity is worth for that last year. And you might not want to leave to another job where you're not getting paid as much or where there's just a lot more uncertainty and risk around the equity value.
The better the company's doing, the harder it is to leave because you're leaving money on the table.
Yes.
Okay. Wonderful. Yes, we always tell clients that if you can make a bet when you're joining a startup, but you want to do it with your eyes wide open. You make an excellent point about the fact that you have agency. Unlike angel investing, when you join a startup, you have agency to actually help increase the value. If you have confidence in yourself to be able to do that, it makes the equity so much more. It increases the potential value of the equity. But at the end of the day, equity should enhance your financial plan. It should definitely not be your entire financial plan.
Absolutely.
Cool. Okay. So helpful. I'm just going to recap some of those questions and help me here. So when you're negotiating or when you're in those early interview conversations, once you feel like you're talking money, asking for the most recent public valuation that's on the table, asking for a fully diluted share count, and then using those numbers to back into your ownership in the company.
Or just ask them outright, what ownership, if you're giving me X many shares, what ownership does that represent if all the options are exercised?
One other thing I just thought of, thank you. One other thing I just thought of is that a lot of times you'll want some legal counsel, and whoever's legally representing the company cannot also help you who's joining the company. So what are the tips and tricks there? Who should you look for? Who can help answer some of these questions?
Any employment lawyer will know the space pretty well.
Cool. Employment lawyer it is. Liran, thank you. Before I let you go, we have a little tradition here. It's called Best Bite. As you know, because you are too, I'm a big foodie. So here's how it works. So every guest leaves a food recommendation for the next guest, one drink or dish from any restaurant, doesn't have to be in New York City. And you won't know who you're recommending it to though, so that makes it kind of fun. Your bite was recommended by our last guest, Ian Steinberg, who is a prenup expert. I mean, his best bite, since you live in New York, curious if you had it. It was the Supreme Pizza from Ruby Rosa. Have you ever had it?
I've been to Ruby Rosa. I've not had the Supreme Pizza to the best of my recollection.
That is your recommendation from Ian. And if you had to pick one dish or drink from any restaurant, take your time.
I'm going to cheat a little bit because I don't know when this is going to air, but it's 98 degrees today in New York City. And it was close to that yesterday. And I had some salted cashew ice cream from Anita's in Flatiron, and that was really good.
Wow, that sounds
in a cone, of course. I don't eat ice cream in a cup. I don't understand.
Really? Fresh pressed waffle cone?
No, regular cone's fine.
Okay, so say that again. Salted
cashew ice cream from Anita in Flatiron.
Love. That is going on my list. Amazing. I can't wait to try it. Okay. Thank you so much for spending time with us today.
Thank you for having me.
To my listeners, if you've ever stared at a startup offer and thought, this sounds exciting, but I don't actually understand what I'm signing, I really hope this helped. A big thanks to Liran for helping us break it all down. And as always, please share this episode if you have a friend, maybe who's interviewing at a startup. And if you're wondering how equity fits into your big picture, we've got a lot more coming your way. Thanks for listening to the F Word. All right. See you next time.